this smart investing has to be done before one gets into a retirement and a post-retirement situation, because until you retire, you have a regular income. If you have a regular income, you have a possibility of making regular investments. After your retirement, unless you're in a profession where you could keep earning, like a consultant or a lawyer or a doctor, you have only expenses, right? You have no income. If you have only expenses, you could hardly be expected to invest as a part of your earning. But I still go through a couple of slides to tell you what anybody could do before, maybe 10 years or 5 years or 15 years before their retirement. This is usually a fairly good time to be in terms of earnings and savings and investing, provided the previous 20-25 years have been done prudently. This is the time the overall household expenses should be going down, because the children would be in college, they would be moving out and start earning themselves. Home loan also ought to have been sort of paid back by this time. It's only for a small number of people, if they have dependents of some kind or the other. That's about the only liability. There's literally no liability. And this is a period when a lot of money should be saved. And this is also a period, remember, that you still have about 15 years or 20 years or at least 12 years to be able to save and invest quite aggressively, because you have an assured income right up to 58, 60. If you're at this stage, this is how you should be investing. This is an indicative asset allocation, and it's called, fairly simplified. Nothing more complicated is needed beyond this. If anybody is telling you to go into any other product, of course, one has to choose the right mutual funds and the right fixed income, but we can debate that. But a third category of product is not needed. You don't need to add gold. You don't need to add structured products. You don't need to add sort of commodities and real estate. Someday we'll start investing into financialized real estate, meaning real estate like a mutual fund. You will be one of the 1 lakh subscribers in a fund. The fund will invest in a real estate project. So you get a tiny share of that, like you get a tiny share of a company, or a tiny share of a stock in mutual fund. That is called real estate investment trust. SEBI has cleared it. Someday it's going to come. In India, everything takes a lot of time. Even that is not needed, because the only home you need is the home that you're living in. And as I said, my assumption is that by this time, your home loan would have been paid off, and there's nothing more to be done on the real estate front. There is no fourth or fifth or sixth or seventh category of assets. So if people have a lot of money, they can possibly buy painting, but that's not an asset for investment. That's an object to be hung on the wall and enjoyed. It's illiquid, it's speculative. You may have bought it at a price, and if you have to sell, you possibly will sell at a lower price than that, and so on. So net, this is all you need. And if you were to do this over 15 years, this is the kind of return you could possibly expect. At least 10 years, not even 15 years. I've assumed an investment return from equity mutual funds of about 12%. And if 60% of the money is invested in that, that is 60% of 12% is 7.2%. I've assumed a return of 7% in fixed income, and I will explain how it's possible to get a 7% in fixed income. 40% of that part of the portfolio gets you 2.8, so on an average you're going to make about 10%. If this continues, on an average, this is all average. Obviously, the equity part is going to go up and down, and it's not going to be a smooth line like this. Is only the second part is going to be a smooth line, because it's a fixed annual or quarterly interest payment that you're getting, so it's going to be smooth. The equity part is going to go up and down, but I've taken an average. So in the end, it's going to work out to 12% or so. So if somebody is able to invest 40,000 per month and that grows at 10% per annum, you're likely to end up with 1.66 crore over this period, which is 46 to 60, which is over 15 years, which is not a small sum. And a lot of people must think along these lines. Now,
excuse me.
Yes.
When Sucheta talked about losses, would you say anything less than 1.66 crores would have been a loss?
I have assumed there are two issues here, which is that 60, which is the terminal time, I'm making a calculation. If the market is that year has crashed by 50%, then it'll be less. If it's a year which is like 2015 or 2000 or 2008, then it may be 2.5 crore, because your average returns in that case would be about 16% or so. So I have assumed fairly conservatively 12%. Last 20 years, HDFC equity fund has grown by 21% compounded. So if you take 21%, this is going to be 3.5 crores, and I've assumed half of that. So the timing is crucial on that particular date. I mean, nobody is saying that you pull all your money out and this is on that particular date of that year, the day you retire. But an average of 12% in mutual fund is conservative. The reason why it's conservative is because in India, inflation itself is 8%, 9% kind of a situation, especially in the urban areas. No matter what the government data tells you. And mutual funds go and invest in good quality companies, which essentially means companies which are not at the mercy of inflation, but ride the inflation. So, to give an example, if Nestle has to pay a 15% increase in salaries next year, you can very well bet that they're going to raise prices across the board and you're going to pay for it, which is why it's Nestle, which is why it's not Tata Steel, because they, in technical terms, they're called price takers, they're not price givers. So mutual funds are supposed to invest in high quality companies. When I say high quality companies, I mean companies which are at the top of their business, the companies which are not at the mercy of the external forces. So they are able to take advantage of inflation rather than like us, we are at the mercy of inflation. So we want to be on their side, not on the other side. So it's a government and large quality companies who take advantage of the inflation, always, right? So, which is why a 12% is not something that will fall from the sky. It's not guaranteed. It's not God-given. There is economic principle why it is 12%. If there is a 9% inflation, you can very well assume that the quality companies are going to get a premium on that. So 9% plus 3%. This is how the economics actually plays out. And this is why good quality companies keep growing over a long period of time, because they dictate. They set the prices. They set the prices and they take their pound of flesh. That's how capitalism works. You can argue why iPhone should be priced at 65,000, but it is. And you have to pay for it. And it's the shareholders of Apple who gain at our expense. So we would rather want to be shareholders of Apple rather than consumers of Apple alone. You can be both. So it's the economic principle which is at work here, and 12% is fairly conservative, according to me, on a 15-year scale, certainly. Also, usually the mind starts reacting, pushing it back to something like this, because it sounds so 12% tax-free, it's so extraordinary, whereas banks are giving me only 8.5%, must be something wrong. People tend to push it back with all kinds of external cherry-picked events. What if? What if there is a recession? What if Europe breaks up? What if there is you've seen a lot in the past, Babri Masjid demolition set us back so many years. Rajiv Gandhi got assassinated, set us back. India had to do devaluation, sell its gold. Indira Gandhi got assassinated. You can go back further. There's famine and World War II. And all of these periods, the bad periods, are enclosed in a 15 and 20-year period. There's nothing unique about it. There's nothing unique about any 10-year period being exceptionally bad or any other 10-year, 20-year period being exceptionally good. India has always faced problems. The key fact is that the companies that we are talking about, high quality companies, and many of them, they're in fund portfolios. They, especially the multinationals, and the examples I gave is all Nestle and Hindustan Lever. I'm not advocating that you go out and buy these shares. That's a different story. But I'm saying that how they work. How they work is that they have a margin, and they're going to protect that margin at any cost. If Nestle can't raise prices, it's going to squeeze its suppliers. It's going to say, sell me the coffee at a lower rate this year. I can't afford that price. And the supplier has to sell it at a lower rate because it's dealing with Nestle. And you as a shareholder and a mutual fund, which is Nestle in its portfolio, is going to benefit. This is how it works. So post-retirement, there are a lot of issues. And they're really complex issues. Because there are too many moving parts, including the biggest issue is that how long am I going to live? If I knew that, then everything would fall in place. But that's the biggest unknown, and because that is unknown, everything else becomes unknown because everything is linked to it. Ultimately, if at 60, if you knew that you're going to live for another 15 years, you will have a certain kind of savings, investment costs. But if you know that you're going to live for another 30 years, you have a real worry that you should not be running out of money. Now that lack of that knowledge, that how long will my savings last? Can I invest in certain things so as to make it last longer? These are the real issues. And eventually, some people are very fortunate to retire with a pension, either paid by a multinational company or even now the Indian government, so that they are in the taxable bracket. They are in the funny position that their post-income retirement is taxable. I know several people who are like that. Based on their previous investments, maybe they have a lot of bank fixed deposit. Plus, they have a indexed pension, which the government of India still gives. So they are earning 50,000 rupees a month or 60,000 rupees a month, which is taxable. So there, the issue is also of where should I invest so that I get a tax-free return or a return which is shielded a little bit from the taxes. So here are the issues that one has to deal with. Where to put the corpus if you have an X amount of money, because this is a lump sum that you've created. You are not in the happy or unhappy position of being a 28-year-old who has no money or who has a little bit of savings and then can look forward to an infinite number of years for that person, not even think of retirement. But here, you are in the happy or unhappy position of having X amount of money and you need to really worry where to put the money. What is the average expected return that I could gain from this? What are the tax implications of the returns of the corpus? How long will this going to last? How much and when to withdraw from the principal if necessary? If I'm invested in equity funds, as the previous chart showed, when to start withdrawing from equity mutual funds. And very importantly, if I'm invested in equity mutual funds, when to exit or partially exit, or what to do when, and most crucially, what is the post-retirement income and support that one could have. Now this is something that again nobody can calculate, budget, or whatever. Most Indians around me, at least I can see, are in a happy position of being supported by the children. In some cases, some rare cases not. in any case, this is not something that you can plan for. This is only time will tell whether you're in that happy position or not. If not, you have to budget for it. My entire presentation is based on the assumption that you will be on your own and you do not want to be dependent. In fact, Indians are fairly clear that they do not want to take favors from their children. They're just happy that they're supported. Now, to take off from that number that I created right in the beginning, over 15 years, your corpus is 1.66 crore. If you remember that figure, I talked about 40,000 per month. A blended return of 10%, 12% from equity mutual funds and 7% from fixed income would grow to that 1.66 crore would go to that's the corpus that you retired with. Now here is the issue. If you have invested it in a product or a set of products so that your average income is about 9%, which is the top figure, and you're starting off your monthly expenses, which is around 60,000 rupees per month, and assume that your expenses, yearly expenses, thanks to inflation, is going to grow at 9% per month. So I've made 3 assumptions. I started with 1.66 crore. My monthly expenses are 60,000 per month, and both expenses and inflation, but both the interest rate and inflation is 9%. This would immediately give one an impression, if you didn't know, look at this chart, that I'd be fine. 9% inflation, 9% interest rate, they cancel out each other. 60,000 rupees is going to last a long time. Well, it won't. Somewhere beyond 19 years, the cumulative effect of 9% compounded inflation is going to cross this point. From that point onwards, you are dipping into principal. From that cross. Until then, for a brief period, your cumulative 1.66, 9% compounded is growing. Your expenses are also growing. From somewhere there, it stops growing because this is where you are starting to dip. Here it goes below your expenses. And your expenses start rising. At 9%, it might sound extraordinary, but over 25 years, if you start at 60,000 rupees at a 9% inflation rate, your expenses are going to be 4.8 lakhs per month. This is a pure arithmetic. I have not changed anything of it. This is not my imagination. I have just compounded 9% over 25 years, 60,000 rupees per month. That's a figure. A figure may be lower, it may be higher, depending on what other sources of income you have. You may be supplemented and so on. If for some reason that you are not invested in a set of products which grow at 9%, but at only 6%, which is this purple line, that leads to even faster depletion of capital. Fairly early it goes down. Okay? So not to get scared with this chart, because all these are assumptions, and in fairly controlled conditions, as they call it, you change the assumptions, the whole numbers are going to change. Just to indicate the fact that this is a period, this entire period, there are only expenses. And income is only from the corpus that you have created at 58 or 60, when your income stops. So not only you have to start with a higher corpus, if you are in a situation like this, but you also have to, in this post-retirement period, you also have to choose to necessarily look for higher yielding products. There's no getting away from it. Traditionally, people talk about those who are in the 30s and 40s are capable of bearing risk. So they are the ones who should be investing in high-risk products, which is wonderful. If you had done that, and if you had saved every penny from the time you started working and invested in equity mutual funds, as I said, 21% compounded over 20 years would have been a huge number. The kind of return that 5,000 investors only in HDFC equity fund have got. 5,000 people only have remained with the fund from beginning to end in this vast country and earned 21% compounded. And I'm surprised that there are 5,000. I thought there would be a few hundred. The longer you are, the better off you are. I'll tell you a very interesting story. Fidelity, which is now a 70-year-old, I think it launched in 45-46. 1945-46 in the US. It's almost a 70-year-old organization. They recently looked at their folios, all their investors. Who are the ones which made the maximum amount of money? It'll be funny to hear there were two kinds which have benefited the maximum from investing in Fidelity. The first category, those who are dead. The second category, those who had forgotten that they invested in Fidelity. These were the two highest earners of the funds. So I'm glad that at least there are 5,000 people who benefited from 21% compounded annual. If you had done that, you would be starting with 4 crore, not 1.66. And then you wouldn't have to listen to a presentation like this. You would have to say, well, I'm okay. I don't need to take risk. I put 4 crores in the bank. Doesn't matter. I pay taxes. I'll live till 100. My money won't. I won't run out of money. I don't care about higher yielding products. A lot of people are not in that happy situation, and it's not to blame them, but it is really, really difficult to invest every penny of your money when you're young. It's only there on paper, and it's only there on charts like these. People don't live life like this. Rahul Yadav says that I'm not interested in money. You know, he's a young CEO of housing.com. Following this, we need to know which other products to invest in, so that 9% can be pushed to, you know, a little higher, 10%. Even a 1% difference is going to make huge difference. In a situation like this, if instead of 9%, if somebody earns a blended return of 10%, he's safe. Money will last beyond 95. We've done the calculation. The popular safe investment product, post-retirement products are these. One, immediate annuities. You have 1.66 crore, give it to LIC and earn a check every month. It's a horrible idea. I'll explain later. Second, senior citizen savings scheme. It's not a bad thing. This is okay, but there's a bit of a problem there. Then monthly income plans, as they call. These are all mutual fund schemes. None of these are great choices, and I'll explain. The immediate annuities, payment starts immediately. It's like give them the check today, they process the paper, and you start getting your monthly annuity payments. Annuities are a 1900 product when there was no other options available. When life insurance companies were really the investment companies to go around, there were no mutual funds. Stockbroking was all, you know, sham and crookedness. 2 hours of work in the afternoon, stick those guys with all kinds of Dutch shares, make 2.5-3% from them, and so on. All that has changed. Today you have mutual funds, and you can invest in high quality stocks all by yourself in a fairly safe manner for a long period if you have behavioral traits worked out correctly, which is if you don't get swayed by highs and lows, and if you don't listen to sort of tips, and you don't listen to don't ask around what to do, and do your own work. Good high quality stocks, 10-15 years you're going to come out very well. This wasn't very easy to do earlier. There weren't many high quality stocks to buy at all. Life insurance companies will give you an annuity on an average of 4.5-5%. I've generously put a figure of 6%. This is far worse than anything that you know. And the only thing you know is bank FDs, which is 8.4%. It's fully taxed. Several people have tried to approach successive governments, the last one being Pranab Mukherjee, and said that annuities, who buys them? Senior citizens, they don't have any other source of income. Why not make it tax-free? So it's in that context that what Sucheta mentioned, that Pranab Mukherjee said, our priorities are those who do not get 2 square meals a day. You are the creamy layer who can buy annuities. Get lost. So annuities continue to remain taxed. If you get 3 to 6% as income, and if it is taxed, you have to of course look at your condition, whether you're in the taxable bracket or not. If you're in the 10% taxable bracket, it comes down to 5.38%, and I assume 6%, very generously. If you're in a 20% tax bracket, it comes down to 4.76%. If you're in 30% tax bracket, it's just 4.15%. Who on earth would want a product like this? Certainly not who are in the 20 and 30% tax bracket. Not even those who are in the 10% tax bracket. 5% is like savings account, not even FD. All right. So that's the problem with annuities. Senior citizen saving schemes are better because interest rates are a little higher, but this is a little old figure, 9.3%. This figure has come down a little bit. But you can invest only up to 15 lakhs. Certainly not 1.66 crore. Okay. Maturity of 5 years, you can be extended only for 3 more years. So it's not a long duration product. It's not a long-term product. You can't hold this like stocks or equity mutual funds forever. Or 15 years, which I talked about, or 20 years I talked about. And it is taxed. So post-tax, these are the effective rates if that is the rate. Same problem as annuity, slightly better, but there are serious problems in terms of the amount you can invest and the period you can invest, and it's locked in.
These are mutual funds or these?
No, these are sold by banks.
They're fixed deposits.
Yeah, fixed deposits. Then come monthly income plans, which are sold by mutual funds. They are funny products. They primarily invest in fixed income, but they want to give you a little boost of equity. So there's an 85% in fixed income and 15% in equity. Now, what are you going to do with 15% in equity? It's neither here nor there. You're not going to get the returns of equity, and you are exposed to the risks of equity. For somebody who is risk averse, for them it's a horrible product. I don't know whom it is meant for. Those who are risk takers certainly will go into mutual funds. And separately, as I said, invest in bank fixed deposits, invest in equity mutual funds, get a blended return. If you want to do it through MIP, this is what you get, 85-15. Now, the problem is that this is not a fixed income product. Nobody gives you a check at the end of the month or at the end of the quarter. This is a capital product. It's like shares. It's like bonds. So you get an NAV which goes up and down, linked to the underlying value. That underlying value moves up and down like shares. Not as volatile, but certainly volatile, because the MIP does not invest in a fixed income product to give you a fixed check every month. So in that sense, it's neither monthly nor income. And it's a funny kind of a plan. It is taxed like a because it's a capital asset, like shares or bonds. It is taxed under the capital gains tax. It's not taxed as an interest income. If you invest money in bank FD, you get an interest check. Taxed or not taxed, it's an income. This is not an income. This is gains. Gains or losses, like shares. And it's got its own set of rules. And those rules are, below 3 years, it is fully taxed. All right? At the slab rate. So if you're in 10% slab and if you have made a gain, that gain will be added to your income and you will be taxed 10%, 20%, 30%, depending on which slab that you fall. More than 3 years, you are taxed at 20%, with the cost of this going up as an indexation element included in it. It's just like a real estate. You bought a flat today, you sell it after 3 years. If you make a gain of 1 lakh rupees, suppose you bought a flat at 20 lakhs. 3 years later, at 25 lakhs. You make 5 lakhs of gain. You will have to pay 20% tax on that 5 lakhs. But there will be an adjustment to the cost. So it won't be a 5 lakh gain. Your 20 lakh cost of the flat will be adjusted upwards because there is inflation. So suppose it is 22. So your actual gain is only 3 in the eyes of the income tax department. So you pay tax on the 3 lakhs. That is called, this adjustment of your cost going up with inflation is called indexation. That the same thing applies over here. The big problem with this is that 85% of it is invested in fixed income products which may be market linked. Now, how does that affect us? Assume that 85% it is invested in bonds. If interest rates go up, bond prices go down. Like shares, they go up and down. So if you are in a 3-year period when interest rates go up and also share market goes down, so your 85% will be at a loss, your 15% also be in a loss. There are periods when MIP has given 2% return. 3 years, 2%. It's in the nature of that product. In some 5-year period, they have given a return of 11%. So the returns have actually on an average varied between 5 to 12% over 3 years. Okay? This is the, sorry.
These incomes you're talking about at the end, is this on exit or is this on the monthly income? Or there is
no monthly income.
There is no monthly income?
No, it's like real estate. You invested, you holding it, you sold. If you sell it before 3 years, there's a certain tax rule. If you sell after 3 years, there's a certain tax rule. On a gain, you will pay a tax.
But they're not giving you a check at any.
No, nothing at all. They're not giving any check. They'll return your money with profit, with loss, whatever the situation is, depending on the period. It's like shares. It's like shares which don't go up and down much. It's like that. This is how financial industry works. They know what is the hook for you. The most brilliant advertising in this country is done by a government organization called Life Insurance Corporation. They know exactly what the hooks are so that people fall for it. So this is what the MIP is. Usually these are pitched to people who think it's monthly income, it's secure, only 15% in equity, without realizing that 85% also can go down and inflict a loss. Now, where to invest if this is the situation? First, we need to know, as I keep repeating, kitna deti hai? What is the mileage that the car gives? What is the mileage that various investment products give? These are all average figures I'll share with you. These are figures which are based on history, based on 25 years of history, and fairly accurate. So, as I said, from good quality equity mutual funds, very conservatively, 12%. Moment it crosses 1 year, it becomes tax-free. So we always say, always invest in shares and equity mutual funds for a period of not less than 5 years, not less than period of 7 years, certainly. So in any case, more than 1 year, it becomes tax-free. This is the single biggest advantage. Anybody who's anywhere in the tax-paying bracket must consider tax-free income, tax-free gains rather, not tax-free income. Bank FDs, 8.5, 8.4, 8.75, whatever. This is the single biggest asset class of Indian investors. They're the most popular for reasons. They are safe, they're easy, and they are guaranteed, almost. Nobody is going to lose money investing with a public sector bank or even private sector bank. They are all very well regulated. So theoretically they are risky and you have only 1 lakh of guarantee. But in India it's not, banks are not allowed to go bust. Scheduled banks. Cooperative is a separate story. Like Global Trust Bank. It was a loss-making bank. One fine Friday over the weekend, the government called the chairman, the RBI called the chairman of Oriental Bank of Commerce and says, we want you to get merged. and that saved the Global Trust Bank shareholders. That was the closest we got to a bankruptcy in the last 25 years I can think of. So they are absolutely safe in that sense, in practical sense, not in a theoretical sense. So that's why people put money in bank FDs. These are all very valid reasons. As I said, senior citizens, it's 8.9%, sorry. I had written 9.4, it's 8.9 right now. And taxed. Then there are tax-free bonds. This is a terrific product for a certain period. Now, this is a problem with financial products. The best ones have to be monitored and tracked and timed. The best ones. If you don't track them, then you think if you think you can go in any time and come out any time, then your option is only bank FD. Tax-free bonds were issued in 2012-13 and offered an incredible opportunity, because that was a time interest rates were high and they were issuing bonds at 8.7%, 8.9% or so. These were all government organizations. Only government organizations were allowed. So National Highway Authority of India and Indian Railways Finance Corporation, all of these companies issued tax-free bonds. These bonds can still be bought. They are listed in National Stock Exchange like shares. They're traded every day. You can sort of get that particular number, the code number or whatever the number of that particular bond that you want to buy. Call your broker and say, I want to buy this bond. This is the price. There's buyer, seller. He'll buy it for you. You pay him the money. The bond comes into your Demat account, just like a share. Listed in NSE, can be bought through a stockbroker, comes to your Demat account. As of now, today, if you buy these bonds, this is the yield. Bond prices go up and down. Therefore, the yield varies. So, if you bought bonds at 8.5% when it is 100 rupees, it remains 8.5. But then if you buy it at 110, your yield becomes lower, because you paid 110, you're getting 8.5. So, it becomes 7 point something. So, that's the situation. Since interest rates have fallen from the time these bonds were issued, their prices have gone up and the yield has come down. Even then, for those who are in the 30% tax bracket, this is the single best option. Nothing is better than this. Nobody is going to give you 7.5% tax free. No fixed income product, which you get a quarterly check. You can hold it for 15 years or so. 10 years and 15 years, I think, are the two tenures. The only problem in this is that you buy today and interest rates go up. Everybody is expecting interest rates to go down. For some reason, if the interest rates go up, today you will be buying at 110 and it will come down to 100. The original issue price, let's say. The condition that was there in 2013. If you hold it till maturity, nothing is going to happen. You will get your 100 rupees back, whatever you paid, and you've got your yield. Okay. If you bought, it comes down, you need money and you sell, then only you book a loss, which is not a common situation. So only one small part of your fixed income portfolio, if you are in the highest tax bracket, a part of your fixed income portfolio can be bought, can be put into tax-free bonds and held till maturity or whenever you want to exit. It's an excellent product.
But when you sell, you pay capital gains?
Yeah, you will pay capital gains tax, small amount. If it's no, there's no lock-in if you buy in the secondary market. Today you are not. There's no new issue. Now there is you're buying the way you buy. Similarly, you will sell. Somebody has sold it to you, right? So you will sell it to somebody else if you want to. The capital gains beyond 3 years, again, same story, 20% indexed and so on.
So when it's being bought from secondary sources, there is no indexation?
There is small amount.
Even though it's...
Yeah. So then there are short-term debt funds. They don't go up and down much. Debt funds, by the way, are also categorized as fixed income products. Again, it's a misnomer because nobody gives you a fixed income. You invest at a certain NAV with a mutual fund. You exit at a certain NAV with that same mutual fund. You make a capital gain or capital loss. You don't make any income, and it is certainly not fixed. It goes up and down with the market. But short-term debt funds are much less volatile because it's very easy to predict or decide on interest rates, which is on a short-term basis. It's on a long-term, the volatility becomes much more. So these funds are all invested in short duration instruments, a 90-day commercial paper. Their things are not going to, unless there is a calamity of immense proportions, unless Mr. Narendra Modi is shot, these markets are not going to be moving up and down much. And roughly you get about 8 to 9%. Same story, capital gains, hold it for 3 years, and you're going to get indexation benefit. Another pretty good option. Then there are corporate fixed deposits. Very few these days, because the government has changed the rules about fixed deposit. All and sundry, any kind of company would have come and sort of raised deposits from you. That rule has changed from 2013 Companies Act, ratified by Parliament 2014, amended. So only companies of a certain size, which is 500 crores plus, they have a humongous amount of compliance, onerous responsibility on the companies to make sure that the investor is not cheated. So FD is much safer today. Corporate FD, you're not likely to have a, Yash Birla kind of a situation very soon. They won't be able to raise money at all, those kind of companies. So very few are available, but whoever is raising money, good quality companies are offering about 9% or so, which is slightly higher than bank deposits, but little higher as well, which I'll explain. Then corporate bonds, little more risky than those tax-free bonds, therefore a little higher return. So India Infoline, for instance, may be offering you a bond of India Infoline would have been issued 2 years ago, traded in the market today, or maybe issued now. These Shriram and India Infoline keep raising money. So they'll come and offer a bond, so you subscribe to the bond at par. Usually the coupon rate is fairly higher than bank deposits. If it's Shriram, it's safe. It's India Infoline, I don't think it's safe. So you have to make a judgment on what kind of companies you're investing in for the sake of, but definitely worth looking at because they are at least 2 to 3% higher than your bank FD. These are all your options other than your normal bank FD, which is very convenient and easy.
So bought through the stock market?
Both. If it's a fresh issue, then it's like, those forms. You have to fill up the forms with a check, deposit, and so on. But in any case, all of them are now in DMAT. They come into your DMAT account, so it's absolutely no paper transaction. In case you want to buy previous issues, they are all listed, and they have to be compulsorily listed in the stock market, in NSE, in the bond section of NSE. So they'll get listed. If you want to sell, you can sell after having bought them from the primary market. So these are all the options that you have. Not much talked about, but all of them worth looking at. Now, I've just described two scenarios. Scenario of investing 25 lakh corpus at retirement. Scenario 1, where you're investing only in bank FD, what the majority of people do. And scenario 2, where you are investing a little bit more in higher yielding products also, and see the enormous difference the scenario 2 makes. Now, if you are invested 25 lakhs in a bank FD earning 6.3% post-tax. Why 6.3%? Because if you could be in a 20% tax bracket or 30% tax bracket, you're going to get 85 lakhs after 20 years. This is how your money would grow. If only you could earn 2% more than that, it will result in 38 lakhs more or 45% more, just 2%. Okay? This is how it will look. Again, these are compounding figures. Put it in an Excel, calculate yourself. This is not my imagination. It's what the figures tell me. So it is worthwhile to try and earn that little extra 2% through a combination of products where you would invest. Fixed income, mutual funds, wherever. I'll come to that a little later. Now, to get that 2%, you have to think a little differently than only bank FDs. You have to think beyond bank FDs. I believe post-retirement, all of us need to plan for 25 years, if not 30 years. You want, and most people want, 100% safety. And that's human nature, and nobody can question that. We do want to protect our money completely, and therefore we choose, as I said, the easiest and the simplest and the guaranteed option, which is bank FD. But you're not going to get 2% extra if you're not going to take a little bit of risk. In fact, according to me, given the longevity, increasing longevity, and the inflation that is here to stay with us, even under the new government. In fact, this is a tax and spend government. This is not like any other government. It's just like any other government, and wants to be a little more efficient kind of a government. But interest rates are not going to drop much, and inflation is not going to drop much, because of the variety of schemes and more schemes that are coming. These are all government-funded schemes. We have to assume a little bit of risk if we were to beat inflation and not fall into the trap of that chart that I talked about, where inflation is 9%, and over a period of time you have to dip into your principal. Higher yielding products. How to deal with it is to move to a two-part portfolio. That's what I suggest. Keep them two separate buckets. Fixed income, put 60%. If I was 1.66 crore and I'm 60, I'll put 60% of that, which is like 1 crore rupees, in fixed income related products. Fixed income is fixed income, not things that go up and down, not unfixed, like bonds, bond funds. And I definitely give it time the way I'm giving time for the equity part as well, and growth part to take care of inflation, which would be about 40% or so to beat inflation. If I do this, this is the kind of return I would make. So in the previous case, I had assumed 6.3% from bank FD, and I said another 2%. Here I am telling you how to get that another 2% or more, 2.7%, which is aim for equity mutual fund return of 12%, and aim for a 7% return on the fixed income part of the portfolio. So blended return from the two is about 9%. 40 into 12 is 4.8. 16 to 7 is 4.2, total 9%. And you will definitely keep up with inflation. When 25 lakh became 85 lakh in bank FD, in this case, it's going to be 1.4 crore. As I said, there are two components. One is equity mutual funds. You obviously have to choose. The single biggest reason why people like to keep their money in bank FD is because there's nothing to choose. Between one bank and another, it's really 0.25% difference. Banks are everywhere, ubiquitous. You're next to your house. You just walk in, put in your money, get a certificate, it's done. It's easy, but it doesn't give you that kind of return. In case of equity mutual funds, you want higher return, but you have to make a choice. Fortunately, if you look back, I'm not naming funds over here, but if anybody does even 10 minutes of searching on the net, and these are all freely available today. If you go to Value Research Online or moneycontrol.com, and you can pull down figures of funds that have done very well over the last 15 years. Look for funds that are not new, funds that have been around. We, for instance, we don't even look at funds that are less than 5 years old. It doesn't even come into our research sample. Funds that have been around for, let's say, 12 years or 10 years or so. Just go and see, do a ranking. Large cap, equity mutual funds, 10-year returns. Moment you say 10-year returns, it will not calculate returns for those who have been around for 9 years. It has to be there for 10 years in the sample to give you that 10-year return figure. And there are very few. Mutual funds is a relatively new thing. Bad guys either get merged or get taken over or close the funds. The good guys keep becoming bigger and bigger. HDFC is now a huge fund. Reliance Equity Opportunities is a huge fund. UTI Equity Mutual Fund, MasterShare, these are very large funds. Because they performed, They've taken over funds and they've got the faith of new investors who are putting more money into these funds. These are tried and tested, right? And they're run by good people. If you choose 3 or 4 funds of them, you don't need anybody's help. You can do this all by yourself. 3 to 4 funds that have done very well over a 10-year period. And we have assumed 12% return because it's conservative given that valuations are not low right now. So to recap, aim for 12%, choose them over a sample of 10-year survivors. Not too difficult. Choose between 3 to 4 funds. Don't choose only one. That's it. That's your 40% part. Then you have to look at for the 60% part, which is the fixed income part. Okay. For the 60% part, corporate bonds traded on NSE was very worth when RBI interests are such that bond yields are greater than 8.5%. We're going a little more deeper into what I've said before. In the previous slide, the 2 slides before, I've mentioned all the list of fixed income products and the estimated returns that you could make out of them. Here I'm saying that if you find any time that the government bond yield, and it's very easy to find out, all the papers write about bond yields, you just go and say India government bond yield. It'll give you the figure, 7.87%. So if any time newspapers say that bond yields have gone up, it's a bad time for the bond market, as in interest rates are high and so on. You can be very clear that when the yield is around 8.5% or so, that is the time to buy the bonds. When there's gloom and doom in the bond market because yields are going up, that is equivalent to buying a low in the stock market. It's exactly opposite. The yields will be up because interest rates are going up. So at that stage, buy bonds, because rates will fall and bond values will go up. They move inversely. If it's 8.5%, only for a day in 2013, when there was this huge crisis of foreign funds withdrawing from the Indian bond market, I think for a day or two only the yields had hit 9%. Yields hitting 9% is unheard of in the last 20 years or 17 years or so. It is so expensive, money has become so expensive that business can't afford it. The government is going to do something, or there's going to be a natural forces in the market by which it will go down. So anytime you hear this, you're fairly safe that you are buying a bond market low. This is when yield is high. This I've already mentioned, tax-free bonds. If you're in a 30% tax bracket, this is for one of the finest, traded on NSE. Now I gave you an example of very few corporate fixed deposits available in the market. I just pulled out 2. One is Prism Cement. Again, I'm not recommending. These are only you have to go and do your work to find out which of the fixed deposits that are currently open. They close and the new ones come. There are very few new ones coming. But I was interested to see that there is something called Kerala Transport Development Finance Corporation. It's a Kerala state government thing. Now, in my view, it's only 12 months. What can happen to Kerala State Transport Development Finance Corporation over 12 months? Will it close down? Your money won't come back? Most unlikely. 12 months, you're getting a rate of 10.25%. It's far higher. It's decidedly higher than bank. And my blended rate was 9% to give you that compounded return that I talked about. A 10.25% return is absolutely fantastic. And in any case for mutual funds also, I'm talking about a 12% return also. So if you combine the 12% of that and 10.25% of this, it's absolutely great. But this is going to be only for 12 months. So you have to be opportunistic, focus on this, and these are all listed in all the popular Yahoo Finance and Money Control. Everywhere there would be a tab to say fixed deposits, what is currently open. You have to go and check. The moment your thing is mature or about to get mature, you start looking for it. If you invest now, 11 months later, when it's close to maturity, start searching. Who else is coming with an FD that is good? Sorry? I don't care about ratings. I tell you why. There is, in tax-free bonds, I don't care about ratings in a very limited context. When tax-free bonds came, there were some government organizations which were AAA rated. There were some government organizations which were AA rated, which were borrowing at a higher rate. As far as I'm concerned, it makes no difference to me whether National Highway Authority is better financially than Indian Railway Finance Corporation. It makes no difference to me. I am getting an opportunity to buy another government organization. I don't know the insides of it. I don't go and work there. I'm investing my money in another government, central government organization. Just because its finances are a little better or worse, a credit rating agency has put them in an Excel sheet and given them a lower rating. What difference does it make to the quality of that product, the liquidity, whether the money is going to come back to me or not, whether interest will be paid to me by quarterly checks or not? Nothing. Go for a higher return if you think they're all in the same boat. So once again, between these two, I will certainly choose the second one. If I have to choose Prism Cement, then I'll think of what is the rating, whether it's good enough, what is the liquidity issue. Here, I'll use my practical sense to say no state government or central government organization can go bankrupt in 12 months so as to take my money away. It's just not possible in India, not in 12 months period.
To locate this thing.
Yeah, it's very easy. There's Yahoo Finance and Money Control. They have these tabs where you can locate fixed income. This is open now. This page will list all this. That's how I found it.
To know whether it's the right time to invest.
No, this is open now. So if you have X amount of money 6 months later, that's the time, 5 months later, with a month in hand, you'll start looking. There are fixed period things.
Example of any government fixed deposit not paying interest? Any history?
I'll find out.
Yes, sir.
State Electricity Board is not a commercial. This is private limited. This is a deemed public limited company. State Electricity Board is a board. It's part of the state government. It's a department. Any limited company commercially run with a commercial objective, with a board of directors, is a different structure altogether. There may be cooperative societies which don't pay. I mean, cooperative, consumer cooperatives, backed by government, all of that can happen. But this is a corporate structure borrowing from you for a 12-month period. And between the two, which one you would choose? I would certainly choose the second one.
Is Prism Cement is a private company?
Yes.
Not a government undertaking?
No.
So
it's owned by Rahejas.
Sorry.
Yeah. Oh, government is preferred always. My following slide is going to tell you that it's not my point that you take all your money and put in this one product for 12 months and then again look for something. You have to build a portfolio. You have to build 1, 2, 3, 4, 5 products maturing at different periods. So this, if you are in zero tax, then of course you get all of that interest that one is talked about. This is all indicative, rounded figure, corporate FDs, bond FDs. This is roughly the effective rate of return that you're likely to get. If you're in 20% tax bracket, same thing. Post-tax, this is the return that you're likely to get, and this is your allocation. This is effective return is based on the post-tax return. And divide it 40%, because the moment you're in here, tax-free bonds is 0.
Full amount is
because you don't gain anything by buying tax-free bond. You're not in the tax-paying brackets. You rather put money in a higher rate of tax. So the allocation is dependent on your tax bracket. I'm still saying 60%. If you have no tax to pay, it's fantastic. You just go across and put your money in the bank. But still, you can earn a little higher yield through corporate FDs, corporate bonds, and short-term debts. If you're in 20% tax bracket, this will be your thing. If you're in 30% tax bracket, this should be your. Unfortunately, a lot of tax-paying people probably have the reverse. They'll have 40%, 45% in bank FD, and they pay a lot of taxes. So this is the point. You have to create a portfolio of 2-3 different products within the fixed income, and equity I've already mentioned. This also yes, please.
Nowhere has balance funds been discussed.
Yeah.
What is the reason?
What is a balance fund?
Equity plus larger part equity plus smaller part debt.
How much? How much is that?
Sorry?
How much is equity and how much is debt?
55 plus 50.
65 to 80 and 20 to 40.
Okay. The reason I don't discuss balance funds and I don't advocate balance funds is the same reason that I do not suggest you mix one product with the other. The reason I suggest don't mix one product with the other is because balance funds will never go below 65% in their allocation. You yourself have mentioned 65 to 80. It cannot go below 65. Somebody has mentioned 50 or 55. It will never go below 65 because they get a tax break for being an equity mutual fund. And according to the income tax, you can't, if you go below 65% over a certain quarter or period, the way it's calculated, you lose the tax advantage. Now, my whole presentation is to be able to take full advantage of a risk product and put X amount of money, and take full advantage of a fixed income product, put X amount of money. If you combine the two, you're facing two challenges. One, you will not know when it is 65 and when it is 80. So unconsciously you're taking higher risk because the fund manager has decided to move from 65 to 80 or 85 or whatever. Right? So you thought it's balanced, it's become disbalanced. It's become too much in equity. Here, you have decided on your own and you can preset. If you decide 40-60, 40-60 is in your hands. Alright? It's not in somebody else's hand and you are unaware of it. It's never like that. Second, even if you choose balance funds, you still have a challenge to choose how much to invest in the balance funds. How will you decide on that? And if you decide 40% on balance funds, and I'm saying 40% on equity funds, between one person and another person, the two persons will going to get a completely different exposure to equity. 40% of 65% is 26%. Okay. So you still have to figure out, I've gone down to 26 if I have to do it methodically, that 74% has to be somewhere. Or you have to increase your exposure to balance funds in that case. It can't be 40%. It has to be more. All these complex calculations have to be made to unravel the ready tea that you want to consume. You have to separate the milk and the sugar and the tea, and you have to reassemble. That's unscientific according to me. In everything we advocate, keep them separate, pick and choose what you need and throw away what you don't need. If you have a path, then it's fantastic. But I'm not necessarily saying this is the only way. There are other ways as well. But you have to be clear what that way is. I feel this is a simpler way. To keep them separate, you can track all of them separately and independently.
Your last line showed about 7 to 8% in all three columns. That is a net income
Post-tax.
after the taxation.
Post-tax, yeah. Expected.
See, it's very clear that to get this continuous kind of, which you showed as a simple curve, but it won't really be a simple curve, but to stay on top of the curve for the next 20-25 years, you actually have to be active in it for 20-25 years, because this is something that you're asking us to monitor, I think, almost on a daily basis.
No, absolutely not. Because absolutely not. The only component that you have to monitor, just let me go back. Let's assume somebody is in a 20% tax bracket, which is also unusual. Could be around 10%. This would be more representative of the large number of people, either they'll be 0 or 10%. For them, 60% is bank FD, nothing to be monitored. 15% in corporate FD, which is once a year, if it's a 12-month FD. If it's a 36-month FD, once in 3 years. Corporate bonds, only 15% of your portfolio. Once you buy this bond, what did I say?
You have to monitor it in order to...
only one time, when you're entering. It's like stocks. If you're able to buy somewhere at the bottom, then what is there to monitor? Anybody who has bought stocks in 2011 or 2009 or 2003, he only has to think of an exit strategy. He doesn't have to know anything else, because he is entered at the right time and his cost is fixed, which is at the low. So everything that moves, which is the corporate bond moves, short-term debt funds to some extent, tax-free bonds and corporate bonds are the ones that move up and down. There, if you see the yield any time around 8.5%, just jump in. You've got in at the low of the market. And then you have to decide whether you want to break the principle for some reason, that is, you want to sort of sell in NSE, what do you want to do, gift, this, that. Your exit is a completely different story. But your corpus gets built at a low rate, low entry price.
Mr. Basu, in 0 to 20%, the two brackets, the returns hardly beat inflation.
Hardly beat
inflation.
You have to decide what you want. If you want to beat inflation, you have to. We can only explain what is given to us within the available set of financial products that you can invest in. 99% of the people in this country don't invest in equity mutual funds. They don't. Even whether it's young, old, or whatever, they all think it's very risky.
But they must.
I don't have any other product which is riskier and a higher yield than that. That also people don't. Because even after it's well established, 21% return in the last 20 years, which is an incredible return. Even for a foreigner, somebody has mentioned that Indian mutual funds have beaten Warren Buffett. It's not a strict comparison, because he can't invest his $60 billion here easily. The market will go crazy. But it's a fact that even, let me share this very interesting thing with you. If you plot the price of Nestle, again I'm coming back to Nestle, I'm sorry, virtually any stock would give that same story. The price of Nestle Switzerland, share price, and the price of Nestle India deflated by currency weakness. Meaning a foreigner who invests in Nestle India will suffer a currency devaluation because Indian rupee becomes weak. In 1992, I think, after two levels of devaluation, 92 July, the rupee was around 25. It's around 64 now, right? Because two and a half times it's gone down in value. So anybody who had invested in Nestle in 92 would have suffered a 2.5 times erosion. Even then, if you plot Nestle India in dollar terms, and if you plot Nestle US, Nestle Switzerland, which obviously is in dollar terms, India is like this, and you can't barely see the curve of Nestle Switzerland. So the guy sitting in Switzerland must be thinking, what the hell are we doing? Let's go and invest, find another India, or let's capture another, 10,000 crore turnover in this country. And we don't invest in a share like that. If you want higher yield, you have to increase. I said 40%, because I thought everybody will howl at me. 40% in equity mutual funds. Invest, make it 60. You're going to do very well. If for 10 years you can identify a part of your corpus, any part of your money that you do not need for the next 10 years or 15 years or whatever that percentage may be. It can be 45, it can be 50, it can be 60, I don't know how much that figure is. Put that in equity mutual funds. Why get restricted to 40? And your blended yield is going to be 12%. Because your equity mutual funds, I've taken a conservative figure, actually it's going to be 14-15%. You put 60-70% of that in that. I mean, look at the kind of wealth that you're able to create.
Are the valuation in equity mutual fund cheap or
We have. He's asking whether the equity valuations are cheap or expensive or whatever. Now, this can only be answered by answering that a company like Asian Paints or a company like, now I have no longer Nestle, a company like Asian Paints, a company like Pidilite, they in their lifetime they've never been cheap. By all conventional parameters, they have always been expensive. They have been little less expensive when there is a market crash and then go back to being super expensive very soon. So I'm not saying buy these stocks. I'm saying that on a 15-year horizon, to say that the market, yes, market is expensive. In our view, next 3-year return is not going to be great. The return was there last year. Next 3 years return is going to be normalized, fairly okay. But you're talking about 10-year or a 15-year horizon. If you take that into account, then what do you do? I mean, would you want to wait for a crash? What if the market doesn't fall? What if the market remains at this same expensive level or slightly less expensive level? How are you going to time it? How can an average person who has X amount of money to invest and has 20 other things to do in life other than get bothered about money, how is he or she going to handle this? This can be only handled by taking into account the investment horizon. You are saying it's for 12 years or 15 years, then my answer, only in that context, my answer is, it doesn't matter. Unless you are in a situation where it's super expensive. What would that be? That would be a Sensex of 40,000. What in 2008 January was. And these are, if you want to go deeper into it, these are very, again, easy, simple and freely available. National Stock Exchange gives a list of, gives a P, price to earnings ratio, of 50 stocks on a 4-quarter trailing basis. Now there will be March, December, September, June. Next, after the June results come, it will be June, March, December and September. So 4-quarter basis. Anytime that P is above 22, it starts getting expensive. Anytime the P is about 24 or 25, it is expensive. That's certainly the time to be very, very careful. But at the lower end, it becomes 18, it becomes 19 or so. So between 22 and 19, it's like a 10, 15, 20% move down.
This is the average PE of select stocks.
Or 50 stocks, Nifty 50. Let him speak. Let him complete the question.
One particular basket. Nowadays shares of top 3 cooperative banks are available.
What?
Shares
of
top 3 cooperative banks, and they give dividend of not less than 15%.
Yeah.
So does it make sense?
But they're not listed, no?
They're not listed.
So if you're not listed, first of all, if it's not listed, you're not going to get the tax benefit.
The
tax-free becomes only for shares that is purchased from the stock exchange.
It is taxable. Income is taxable. But dividend is not less than 15%.
Dividend, 15% dividend is no big deal. You have to pay a price for that, no?
No, it's at par.
How at par?
Impossible. No. Saraswat Bank will not give shares at par. It's not possible.
You get shares at par.
Saraswat Bank will not give shares at par. There is a value in that business. I mean, I'm really...
Bank is listed?
No.
So then it has to be at par. Because there's a cooperative bank writing. I don't know. Because whenever I take a
Shamra Vittal, Saraswat and all the 3 banks.
You get shares at par?
Yeah, it has to be at par only.
So that, well, in that case, the risk is that who will you sell it to?
The banks repurchase it.
They buy it
back.
I'm in principle, I'm against it. In principle, I'm against it. You have to be...
You cannot guarantee it. You cannot guarantee the dividend anytime. Because that was done by one cooperative bank, I would not name it. It tried that stunt and it went into liquidation.
So there you are. That's it, essentially. And I have 3-4 slides on reverse mortgage. Very reluctantly, I'm showing them because there's no reverse mortgage product in the market. Now, a reverse mortgage works like this. It's a combination of almost like a home loan and an annuity. Just the cycle moves from this way to that way. you have a house, you give it to the bank or a housing finance company. The housing finance company then passes it on to a life insurance company. Essentially your house is not being sold, but it has to be converted into cash. How can a house be converted into cash? The life insurance company is taking a call that you're going to live for X number of years. Okay? And based on this, that has been passed on to the bank, they give an annuity payment to the bank pays it to you. Now, this is a very dangerous situation. Suppose there are two options in this. Whether you want your house back or you don't want your house back. If you don't want your house back, then the amount is much more. Obviously, because not just the interest payment, annuity payment, the capital value of the house is also can be included as part of your monthly check. The first option is no return of purchase price, annuity kind of thing, which in this case, no return of the house. During the lifetime of the borrower, you receive lifetime annuity and a little bit of bonus, not much. On the death of your borrower, the house goes to, the annuity payment stops first of all, and joint borrowers are possible. The house goes back to the rightful owners. The bank will deduct the money that it is paid so far and give you the rest. Okay? Or you can buy it back. You can tell the bank, here is the money, release the house to me, to the rightful owners. In case of return of purchase price, these are the things that are applicable. In first case, no return. Second case, return. The reason why this is not taken off at all is A, the costs are very high. 1.5% every year to service the principal. According to me, any cost of that level is not worth it. Second, it's fully taxed because what you're getting is like an annuity payment. So it's fully taxed. How much you get is a second major issue. If you do not want to give up your house, and most people wouldn't want to, they may have a legal heir, they may have kids, they may have somebody else to give it to, then the payment you get every month is very little. Here it is. If you do this at age 60, why is it linked to age? Because it's annuity. Because the insurance industry is taking a call how much you're going to live. And based on that, the amount is decided. Loan to value. That is the value of loan that is created based on the value of the asset. If the property value is 50 lakhs, loan to value is 60%. In option 1, you get 17,000, but in option 2, where you want to retain the house, you get only 11,000 rupees a month. If the value of the property is 1 crore, you will get some 22,000 rupees, exactly the double of this. The figure keeps increasing as you go higher because there's much greater likelihood of you popping it when you're 80. So the insurance industry gives you a little more money because they know they don't have to pay a lifetime annuity for you. These are roughly the calculations. Now, this is very important. 50 lakh house value, loan is 30 lakhs. In option 1, you give up the property. In option 2, you get back the value less the loan. You as in your legal heirs. 30 lakhs is given to the insurer. They pay you annuity. Over 25 years, option 1, where you give up the property, is going to fetch you 51.88 lakhs, and option 2 around 32.98 lakhs where you retain the property. After 25 years, a 30 lakh loan, suppose you die, a 30 lakh loan will be 3.25 crore at 10%, I'm just giving an example, and the property value may be 3.42 crore, again just giving an example. In the first case, in option 1, the bank will sell the property at 3.42 crore, deduct 3.25 and pay 19 lakh to the nominees. Option 2, the bank will sell the property at 3.42 crore, get 30 lakhs from insurer and pay 49 lakhs to the nominee because that's a surplus still remaining. Now comes the kicker. If the property doesn't appreciate, the banks take a hit. They know that, which is why they make sure that they give you less of money and charge you higher interest. Second, this is the single biggest problem. In option 1, if you choose, where you have decided, remember, you give up the property. If you die, say after a year, You have got 2 lakhs, roughly. Bank will sell the property at 50 lakhs. Suppose there is no appreciation. Adjust the loan and won't pay anything. The insurance company will pocket 28 lakhs. That's how annuity works.
48 lakhs.
Yes. Yeah, 28.
Minus 20.
Yeah.
I mean 50.
So this is how it basically works. Yeah, maybe 48 lakhs. Yeah. So this is not taken off for a variety of reasons. That you, it's too expensive, it's too hassly, it's, these are the issues. If I die, what happens? Insurance companies taken a view on the, from an annuity angle, payments are too little. Only central bank has tried to evangelize this. But I'm quite certain that over a period of time, this is going to come to the market. Maybe 10 years or 15 years later, because this generation is really spending a lot of their monthly income in EMI and have no money to save. So towards the end, they'll be left with a property which is expensive and too little cash. So that's going to be a large number of people, and they will probably demand a product like this.
Excuse me, sir. In the last 3.5 hours we've sat, we've learned a lot of knowledge. I've gained a lot of knowledge on retirement. Now the next stone is, I think all of us are in the 60 plus age group, right? The next thing coming up is retirement townships. There are 3 already coming into Maharashtra. A few names. One is Tata, Clover. Now this is a new segment which is coming up for the realty market. Now is there any example, is there any a person who overlooks all this, or what are the new things coming up? How far can you? We've
done a cover story on retirement homes.
Yes.
And Sucheta has spent a lot of time and effort in figuring it out.
Yes.
There are some problems. The main problem is exit.
Exit.
So they have severe restrictions on whom you can transfer it to. So therefore, any investment, you have to first think of...
It's a dead investment, sort of. No, only to people who are
only to senior citizens.
People who are 55 and above. And then if you don't have children or wards, then there's a fix over there. Are we doing something on this in the future?
We've done a detailed analysis in the past on retirement homes. We can, if there are more such come, we'll look at it.
Okay, right.
Ashiana is a company which is doing a lot
Ashiana,
of...
yes. Lavasa.
Probably.
Yeah.
Okay, thank you so much.